Good morning, everybody, and welcome to our September webinar for corporate reporting at BDO. You'll see a different face here today. My name is Kevin Frohbus. I'm sure you all know me from previous webinars, but I'm happy to introduce Etienne Gouws today, who's joining me on this webinar. Hello, Etienne.
Hello, Kevin, and thank you for that, and good morning, ladies and gentlemen. Thank you for spending the next hour or so with us. What I'll say is that if you haven't picked it already, you'll pick it soon. Yes, I'm also from South Africa, and to be honest, there are a few people in the BDO technical team that are not South African, but only a few really. So I've joined BDO in April of this year, and I focus on public sector and also energy and natural resources. Before that, I spent some time in the Victorian Public Service. So just my role today will be to share a little bit with you the practical application and the practical issues dealing with intangible assets in business combinations.
Now, Etienne, we're very happy to have you. I'm glad you went straight into the South African thing because, as you can see with his name and accent, he's obviously from South Africa. We felt that it was important that if we were going to have Etienne on the call and he was replacing a letter today, that we needed another South African with another South African accent. So that's exactly what we did. For context, the letter is away doing another session that's conflicting, and so she's away on assignment essentially. And we thought it's always better to have two people on this webinar. So happy to have Etienne on board, and we're going to run through intangible assets and R&D costs. So let's get going. We'll move straight into it with today's agenda. I'm going to probably do the first bit, and Etienne will jump in as we go along on accounting for intangible assets. How did we get here in fundamental concepts? Now, the trick with this standard is that it's an old standard, or the concepts are relatively old. There's obviously been variations along the way, which we'll cover as we move through, and you'll see those most noticeably in the business combination section. But we're going to deal with two specific sections today, being R&D costs in particular, and then intangible assets in a business combination, which Etienne will get into. And we'll do some banter along the way, Etienne, on sort of war stories as we go to share with those online. At the back end, common issues and obviously BDO resources. And I reckon we should just get straight into it. We've got an hour, and hopefully we can cover some of your key issues. This is not a complete session on intangible assets. This is focusing on some of the key elements, and like I said, R&D and business combinations. Etienne, ready? Let's go.
I'm ready.
So I'm going to give us a bit of a background on how we get here, and there's a reason I do this. I've done this previously in some sessions internally. So these slides, you might have seen them in a previous session. That the next 3 or 4 slides, it's just running sort of background on how did we get here. The reason why I want to do it is just to kind of remind you of some fundamental concepts of what the intangible assets standard is all about. It's an old standard. I noticed there's 1998. I mean, that's you know, relatively old. It's an old cost consumption based standard, and what that generally means is it was written in the time before fair value was a big deal in accounting. It's based on the underlying concept of recognize your costs at the amount you pay for them, or the cost, and then depreciate them as you use it, or amortize it as you consume its benefits. And the big deal with the cost consumption based standard back in the good old days was that it was almost an anti-avoidance standard. And I use the word almost because what it generally did was it sent you to this expense first and only capitalize if you can. Rather than capitalize first and then depreciate. It was almost an anti-avoidance. They didn't want you to capitalize things unless you really could. And the idea behind that was to try and separate intangible assets from internally generated intangibles was actually the key problem. And to be fair, that's still the problem today with intangible assets, is how do you separate and recognize separately on the balance sheet intangible assets separate from internally generated goodwill. The key concepts with intangible assets is it did allow revaluation, but it only allowed revaluation of assets, for example, to market value or fair value, if there was an active market. So it's all about cost and cost amortization. what started to change in the good old days of the standard setters is financial instruments was introduced in 1999. Now, that's not relevant to today. The reason why I've put that there is there was a shift at some point to actually, first of all, recognize all assets and liabilities on balance sheet, but also in a big way, the concept of fair value measurement was introduced. And that represented a shift change towards, you know, more assets and more fair value measurements. I call it a hybrid method, but you'll now know that there's some assets and liabilities that are cost based and some assets and liabilities that are fair value based, and that all started with, I guess, financial instruments, and then there was just a steamrolling event when we finally got the business combination standard in 2004. The big concept with business combinations, and it
Given it seems that we may have lost you. Sincerest apologies, ladies and gentlemen. We're just trying to get Kevin back. I think whilst we're waiting for Kevin, I might just sort of touch on the business combination, considering also that that's part of the session that I will be leading. It's interesting that Kevin referred to the intangible assets standard as an anti-avoidance standard. It certainly is one that I have often referred to as, if you can get it recognized under IAS 38, then you've done really well. But with business combinations coming along, you'll actually see that, and it's a little bit of a spoiler alert for later, with business combinations coming along, the requirement is there to recognize quite a number of intangible assets that potentially previously would not have been recognized in the usual way, in the sort of, if you want to call it, the normal course. Just see, Kevin, are you back yet? Sincerest apologies. So Aletta is not here for one session, and then we seem to run into technical issues. Maybe it's just a test for the new guy, isn't it? Whilst we wait, I might go on to the last point on the slide as well, and it links into part of the business combination conversation we'll have a bit later. As part of the balance sheet focus, we now have, as you are all aware, IFRS 16 that requires us to book leases for all intents and purposes, most leases, if not all leases, on balance sheet. And under the old intangible asset standard, we really only recognized in a business combination any off-market adjustments as an obligation or as a right. And certainly the rules have now changed. And in business combinations, we recognize the lease with reference to an asset, right of use asset, and a corresponding liability, but we still need to make an adjustment to the right of use asset for off-market conditions. I'll apologize again just for the brief issue we have. Unfortunately, it's out of my control at the minute, so just bear with us. Ladies and gentlemen, I might just go on mute for a second just to see. Oh, Kevin, you're back. Kevin, I don't know if you are able to hear me. We can't hear you. Kevin, we're not able to hear you. Kevin, I'm not sure if you're able to hear me. If you're able to hear me, we can't hear you, but we can see your screen. Ladies and gentlemen, I might just go on mute for a second just to try and see if I can connect with Kevin offline.
Etienne, can you hear me again? I appear to be
Ah,
back. I apologize. We had an internet problem in the Sydney office. I'm not really sure what that's done for the broadcast, but I imagine it hasn't been a.
what maybe if you just go back to the previous slide and then we can pretend that none of this happened,
Right.
and that we we could move on. So I've taken, because this was the only slide I could talk to.
All right. Good.
I covered business combinations, and I also talked about the changes that were introduced by leases. So back to you.
Thank you, Etienne. And I apologize for that. I will say that's not the worst disaster we've had with an internet connection. At one point, the entire webinar didn't work, so I do apologize for that. I'll talk about my Cambrian asset explosion, and it was at this point that I realized I was talking to no one previously. What I was actually going to say on this particular one, and I think I've actually um, was that after the business combination standard appeared in 2004, we saw this explosion of new types of intangible assets appearing. Things like customer lists started to appear, things that came out of business combinations. I'm going to jump past that in the interest of time. I'm assuming, Etienne, you probably covered that to some degree. But this is a list of the sorts of things that started to appear around the world in, business combination type standards. From the business combination type standards. One of the key features that's on here is the concept of contractual and non-contractual, and I'll come back to that in a later slide on the contractual and non-contractual, because the separability or the identifiability of intangible assets being separable or contractual is quite important to their ability to be recognized. So let's get into that. Fundamental concepts. So these are base concepts. As I said earlier today, we weren't going to be dealing with all the detail in the intangible standard. We're just going to get some key messages in. What I wanted to deal with on fundamental concepts or key takeaways was really the definition of an intangible is largely unchanged. And what I mean by that is for a generational period now, from 1998 at least, we've always had the relatively unchanged definition of an intangible asset. That is important for a number of reasons, mostly impacting whether you actually recognize the thing and how you measure it, but also how you categorize it and then how you determine its value in terms of valuation practices. Etienne will deal with valuation to a large degree later, because recognizing intangible assets at fair value mostly arises out of business combinations. It's almost exclusively in the business combination area. And the big issue there will be, well, how do you actually measure or value determine intangible assets? I've mentioned already that the standard in terms of a fundamental basis hasn't really changed much, and that it was almost an anti-avoidance standard. What that means is expense, unless you can capitalize. That's my interpretation of the standard. It certainly isn't written with that objective in mind. It's just that in practice, we generally end up with expensing costs and cost incurred unless you can capitalize. That seems to be the mantra there. And then I've spoken about the acquisition of intangibles in business combinations. There's some very, very interesting concepts that go along with that. And Etienne will deal with that later. The one key takeaway I did want to mention at this point, though, is that the acquisition of intangible assets in a business combination at fair value isn't undermining the traditional view of an intangible asset. What it actually is saying is that at that point in time in a business combination, because there's an acquisition on the table and there's actually an agreement between a buyer and a seller, you're creating the conditions necessary at that point to essentially identify separately intangible assets separate from internally generated goodwill. It's almost a once-off moment in time when you can actually see clearly what these things are and what they're worth and how they're valued. And at that point, you kind of go back to well, I don't recognize any new intangible assets unless I can separate them from internally generated goodwill again. So the business combination standard isn't so much an exception to the rule, it's just applying the rules in a different way by still following the fundamental concept of you cannot recognize an intangible asset unless you can clearly articulate it or separate it from internally generated goodwill. Those are your fundamental concepts. Is there any comments at that point?
No, I think that's and maybe just I'll give an example of so and I referred to when you were offline, I referred to accounting for intangibles in the business as usual way compared to business combinations and how we look at it from a business combinations perspective. And we can maybe just start thinking about something like a brand. Let's say that a company starts off, they do the right thing, they start building a brand. You would not necessarily see that cost being recognized under 138 for various reasons. It's internally generated. Your ability to really track the costs associated with building a brand is probably impossible if anything. But when we get to a business combination, and you'll see later, we put a little bit of a different lens on that. So brand is a good one to maybe just run through a thread, if you like, through the presentation.
Absolutely. Thanks, Etienne. Look, on definitions and what is an intangible asset, this hasn't really changed much over time. We still got the concept of identifiability. We've given you some reference to the accounting standards there yourself. You can go and read that if you have nothing to do, on the weekend. It's a non-monetary asset controlled by an entity, is without physical substance. The big concept that I'm going to refer to a bit today is separability and contractual, and also power to obtain future economic benefits. These concepts were all designed from the traditional definition of an asset, a resource controlled by a resource or right controlled by an entity, and future economic benefits. The separability and the contractual is quite relevant. We don't have enough time on this webinar to really get into all the ins and outs on separability and contractual, but the idea that these components exist is what distinguishes it from, let's say, internally generated goodwill. And separability is the concept of being able to divide this from the entity. So you can sell this thing or transfer it or license it to somebody else. Or contractual is a right that establishes your right to control underlying economic benefits. Those two concepts are really important, and they're often overlooked when accounting for intangible assets. We all rush really quickly to, I have an intangible asset, but as some of the people in my team will say to me, well, what intangible asset do you have? Because until you know what you have, you can't really progress to anything else: recognition, measurement, amortization, valuation. So separability and contractual are really important because it helps you define the right or the actual thing that can be separated from the entity that is your intangible asset. I won't get into it any further than that. A brand is a good example because you can license or trade under it or sell it. And so there you've got a brand. Contractual is important, like a patent. You've registered a patent and you have a contractual right over it, or some other right. It can essentially be ring-fenced and identified. That's the key issue, and that's also a key issue because if you can't do one of those two things, it becomes really hard to differentiate from internally generated goodwill at that point. Now, the accounting model, this is a very high-level summary of pretty much all the accounting that we currently have in the intangible asset standard, along with, let's say, business combinations as well. All intangible assets, or most of them, will essentially fall into three asset classes. Goodwill, as we've discovered from our previous part of this presentation, is the residual in a business combination. It's essentially the residual after you've allocated the consideration or to the separately identified intangible assets. It's not amortized and it's not revalued, but it's subject to an annual impairment test. We're not doing impairment today. I think we've probably covered that many times in previous sessions on impairments. The other two types of assets are intangible assets, which are finite useful life, and intangible assets that are indefinite. Brands is an example of an indefinite. Generally speaking, we don't amortize those, but we look for annual impairment test. And the finite intangibles, we do amortize those, but we also we impair them when there's an indicator. We're not going to really deal with ongoing measurement today. What we're actually going to deal with, as I said, are the two big issues: business combinations and research and development expenditure. But the one thing I will sort of come back to on a fundamental basis is just cost on date of acquisition. The cost on the date of acquisition for all of these, excluding the goodwill, which is really residual, before the other intangibles that are separately identified or contractual, in other words, separately identifiable, their cost on date of acquisition is either the cash and cash equivalents paid or the fair value of the consideration given. And what those are both trying to achieve is what's the cost of the acquisition of the intangible asset.
Kevin, can I add maybe just on that slide if you go back one, and
Yeah,
just for the attendees in the public sector, we've had an interesting addition to how we think about intangible assets through the Service Concession Arrangement Standard 1059. So those of you that are lucky enough to have service concession arrangement that you need to account for, actually it could include not only property, plant and equipment, but also intangible assets. And you'd know that from 1059, the requirement is effectively to continue to recognize on a subsequent or ongoing measurement basis at current replacement cost, which is interesting because it deviates from the usual way of saying we look at cost unless there is an active market.
that's right. Yeah, very good point there. Thanks, Etienne. All right, so let's get into the session I'm going to deal with today is accounting for R&D costs. Why is this such an issue? Why did we choose this particular topic for today? With separately acquired intangibles, which is what this screen is about, and yeah, we're talking the traditional types like licenses, patents, software, so forth. If you acquire those, generally speaking, the cost can usually be measured reliable. It's the amount you pay for it. That might have deferred consideration or whatever it might be that you're paying to acquire it, but generally speaking, it's a point in time acquisition, and the cost or the cash and cash equivalents agreed to pay to buy the intangible becomes your cost. That becomes a little bit different with R&D costs because R&D costs are by definition costs incurred over generally a period of time while you develop the intangible asset up to something. So research and development by definition is not the same as separately acquired. It's essentially a whole bunch of little transactions or activities that have costs attached to it to develop something up to become your intangible. So one of the key problems with R&D costs as it differs to separate acquisitions is you are developing or researching this thing over a period of time, and how to actually identify or quantify which costs belong to those, let's say, development activities to allow you to capitalize it as an intangible asset. Nothing I've said at this point is actually or should be unfamiliar to you because these are all concepts embedded in the accounting standard. So R&D cost capitalization by definition is an internal generation of an intangible asset, and the key risk here is separating the development of a new intangible asset separately for internally generated goodwill. That's the key objective. And what makes it even worse is that you want to actually split your research phase on your development phase up, because the accounting standard is very clear. You only can capitalize costs for the development of an internally generated intangible, like a research and development of some new software or pharmaceutical drug, during the development phase. Research phase expenditure is expensed when incurred. And then the standard goes and layers more components on top of that. And it actually says that you can only recognize the expenditure in the development phase so long as you can demonstrate in the development phase the technical and feasibility of completing the asset, intention to complete, demonstrate how it will actually generate future economic benefits, that you've got resources to complete the assets and availability of resources, and that you can reliably measure costs or expenditure on that asset. Now that's really all the standard talks about, and none of that is really interpreted in any way or form for the variety of internally generated intangibles that may be out there. And what is actually worse is that those concepts, which are good concepts and they've stood the test of time, were developed way back in 1998, when the types of intangibles that were being developed were very different to the sort of internally generated intangibles we have today. The standard was written for, shall we call, linear or waterfall type development activities. That's where you have a particular asset in mind that you want to develop. You go through a research phase, and then at some point you trip over into development phase. And development phase is kind of clearly observable. You're starting to develop the asset. You've got a team together doing it. You might have a plan or a project plan or a development plan in place, and you can easily measure, or you can put systems in place to easily measure the sort of expenditure that's been incurred on those assets. In today's world, especially with software, you get things like agile development plans where things aren't really being developed in a linear fashion where you've got research and development. There are agile steps along the way where there might be multiple development phases to develop functionalities in software, where you might actually go back to the research phase after a development phase while you choose to make new feature or functionality decisions in actually developing your intangible asset. So those sorts of concepts are not dealt with in the accounting standard. And before you get into development phase on, let's say, an agile software development project, you really need to kind of figure out how to apply these traditional old concepts to a new age of development activities. So let's get into the practical issues then on that. A lot of the practical problems when it comes to developing internally generated intangible assets are going to be the so-called paragraph 57 conditions. So those are the ones on the right-hand side: technical feasibility, intention to complete, ability to use the intangible, how to generate probable future economic benefits, availability of resources, and the ability to measure reliably the expenditure attributable to the intangible. What you really need to do is you need to be able to take those requirements and actually adapt them into a plan, something tangible that can actually demonstrate those concepts and allow you to clearly articulate when you are in the development phase and how expenditure can be identified that aligns with development activities for purposes of capitalization. The, the key thing with this, and I'm going to use software as an example here, is often the systems and the processes aren't available to identify which costs belong to development phase activities and which costs belong to capitalization. And often that is left too late. In fact, that's going to be my key problem for the rest of this section, is to talk about how do we actually, in a let's say an agile software development in the 21st century, develop processes and systems that allow us to capture and identify the costs that relate to capitalization, and that it's not left too late. Remember in the standard that you can't retrospectively capitalize costs. So once you've failed to identify a cost for capitalization, you can't go back and fix that later. And that's one of the key practical problems to be overcome in reality. This links nicely and often to company and product life cycle. In practice, a lot of the clients we have or organizations we have that are trying to isolate development expenditure for capitalization, they are in a big R&D phase, and that often goes with software, and that often happens in companies that are starting out or in the early stages of their life cycle. That's not exclusively true, of course, but with startups and with money sloshing around the system, with venture capitalists looking for new ideas, a lot of the R&D questions that come to us are actually in the beginning phase of the company, starting out, looking to create structures in the business, and you're actually trying to solidify the company stance in the marketplace. The problem with that is that companies that are starting out have not put the systems and processes in place to actually capture or isolate costs for capitalization. And so there's a natural tension between product and company lifecycle and capitalization of development costs, because you're focused on growing the business and actually researching and growing the intangible asset, or bringing the idea of the company to fruition to make it into something. You don't have time to worry about systems and processes to capture costs for capitalization. And so you often miss the opportunity to capitalize these costs early on because you're growing the business in that phase. So that's what I mean by this practical balancing act, is balancing the time and the cost it takes to grow your company and develop your company in its R&D phase with the time and cost it takes to set up all these systems and processes to capture these expenditures in a formalized way. Now, one of the solutions to this, which we've seen in practice, is to actually link your accounting with your tax. Most of the companies who are trying out new things in the early stage of their development are going to be looking to claim the R&D tax incentive, or some form of an R&D tax incentive that might be provided by the Australian government in the form of, either offsets or cash refunds for investments in R&D. So if you are developing a new improved product, process, service, or device, you're trying to solve a technical problem that doesn't have a readily available solution, you're moving through to knowledge and information that is unavailable, and you're trying to test and trial these things. These are the criteria that will qualify you often for eligible R&D tax incentive claims. And this is often when we also identify the opportunity for our clients, because they'll approach BDO not from an accounting point of view, but they'll approach us from an R&D tax incentive point of view. They will come to our tax department at BDO and say, we'd like to, seek out the opportunity to claim R&D tax incentives, and our BDO tax guys and R&D tax incentive partners will help them apply for those, set up the forms and paperwork, and also set up some form of cost monitoring system to actually capture the R&D tax and the R&D costs that are subject to the incentive claim. At that point, it's probably worth thinking about whether there's an opportunity to start to think about capitalizing your development expenditure for accounting. Because if you're going to put money and time into the R&D tax incentive, that is a rudimentary form of paperwork in terms of defining what costs qualify and putting that paperwork through for the actual claim. It's probably going to be the form of the basis that will create your incentive to actually identify the development expenditure that you can actually also account for. One of the tricks here, though, is that you don't have to necessarily do the two together. It's just thinking about the two at the same time, because the R&D tax incentive claim, generally all research and development expenditure that forms under the claim is claimable or subject to the claim. But in accounting, it's only the development expenditure that you can capitalize. So that is a natural tension between the R&D tax incentive and the accounting under the development expenditure, is that not all your R&D expenditure for the tax incentive is capitalized. It's only the development expenditure that is. But there is a natural tendency to put the two together early on and say, if I've got to do paperwork and documentation for the R&D tax incentive, I may as well start thinking about how I can augment that to get my development expenditure capitalized from an accounting point of view. I've summarized on this slide the key features of the R&D tax incentive scheme in Australia. I'm not going to deal with that because it's more for our tax team to deal with that. And what I have done is, at the end of today's presentation, I have the names of the key partners around the country who can help you in our tax team with R&D tax incentive claims and looking to, make use of that. What I will talk about, though, is then if you are going to look at trying to augment your processes and procedures to try and isolate those development expenditure, is to put a second solution on the table for you. So solution one is to tie up this process with your R&D tax incentive claims. Solution two is to actually put a cost capitalization policy in place. Now, this concept of a cost capitalization policy isn't in the accounting standard. This is a tool that we've developed over time, and which a lot of organizations often start with as a guiding document to help them lay the foundations for the process of capitalizing development expenditure from their R&D activities. Without it, you probably won't be able to identify development expenditures for capitalization purely from your R&D tax incentive, because, as I said, R&D tax incentive is research and development expenditure, whereas accounting is just development expenditure qualifies for capitalization. So it's certainly something you might want to align with your tax incentive and cost management systems. What we often do when we put these together, at least on a starting basis, is it's a documented approach where we outline things like the type of development asset you're trying to create. So what is this intangible you're developing? Is it an assessment or a technology asset? Is it software? Is it code embedded in software? And then what we do is we try and align that with the actual development project. The project to development the asset is often not an accounting thing. You'll have specialist developers in place, external consultants, developers. You might have internal staff working on this that are specialized in their field, but they'll be following some sort of formal project plan, development plan, and a set of project activities. And the idea of a cost capitalization policy is either to create this policy that either sits alongside or within your development and project plan and links the project timeline, the development stages, and the project resourcing with the costing and the cost management system, which then identifies and isolates the costs that can be capitalized as a development asset on your balance sheet. One of the things you'll also often do in there is you'll define the nature, type, and timing of the budgeted costs. I've underlined budgeted costs because this needs to be done before you actually get into the actual expenditure, There will be changes along the way. We know that projects change and costings change, but the reason why I said that the cost capitalization policy is defined based on budgeted cost is because that is an indication that you're addressing this issue before you incur the expenditure. If you haven't got this in place and you're already incurring expenditure, including claiming it under the R&D tax incentive, you may miss the opportunity to capitalize those costs because you haven't adequately isolated them in your systems and processes at the time you incurred those costs. And that's especially true if you've got financial year ends happening where where you're closing off your accounts and you're producing financials. You can't go back and suddenly start retrospectively capitalizing costs. And like I said, this is a framing document. It's not going to answer all your questions. It's at least going to give you a starting point on how you might approach development activities. My closing remarks on this before I hand over to Etienne so he can talk about some business combination points is that a little goes a long way at this point. Start with a cost capitalization policy to frame the debate about how you might approach development expenditure identification and then capitalization. Align it with the R&D tax incentives. It's just the next natural step, and like I said, it frames the basis for then investing in systems and processes to then capture that expenditure for capitalization. And the other thing is to think about your exit strategy. Is it worth it? And what I mean by that is some organizations in their life cycle want to actually IPO at some point. And it then probably is worth trying to get a development asset on your balance sheet through a strategy like this, because you don't want to go to market or to your IPO with no asset on the balance sheet, even though that's your big idea. But there are other organizations who may just want to sell the business when the good idea gets to a particular pace. So they're not going to sell it, they're not going to IPO it, they're not going to look for new investors. They're just going to sell it to maybe some venture capitalist. In that case, the venture capitalist might not care so much about the actual number on the balance sheet. They might actually care more about the idea they're buying, in which case they will actually have the opportunity to work out the value of your R&D activities or also the intangible asset they're acquiring in a business combination. In other words, they might actually get all the opportunity to recognize these assets when they acquire the business through business combination accounting. You might not care so much for it, and you might not want to invest in your systems because your exit strategy doesn't need you to identify those costs as capitalization. So really, it's a matter of what's your strategy here. You don't have to invest in these systems, but you may want to, depending on what you want to have on your balance sheet at some point in the future in your company life cycle. Now that's my segue to hand over to Etienne on intangible assets acquired in a business combination.
Thanks, Kevin, and really pleased you're back. Not being able to run the slides from this side was interesting. Ladies and gentlemen, intangible assets acquired in a business combination. So Kevin, if you go to the next slide, what I thought I would just start off with, and those of you that, and I see a few familiar names on the attendees list, for those of you that have spoken to me before, you'll know that I try and simplify accounting concepts and issues more so because, I don't think I'm very smart. We just think about the general concepts of a business combination, and then we'll work out how it applies to intangible assets. So, in general terms, you've got a buyer and a seller, and they transact a business, and included in that business is a heap of assets and liabilities. And as I said, I'm not going to go specifically into the definition of a business and those things because they are effectively included in AASB 3, which is not the focus of this session, you'll be pleased to know. But if you want to talk about those, give me a shout. On the right hand right-hand side of the slide, you'll see the 5 steps that are outlined in IFRS 3, and I've put a nice yellow star next to those that I think are most important when it gets to intangible assets. So just running through them very quickly. First one is maybe not as intuitive. It's a step to identify who the acquirer is, and shock, horror, it might actually happen that the legal acquirer is not the accounting acquirer, but that's a nightmare for a different day. We have to work out what the data is that we acquire, and why that's important is we really need to work out what assets and liabilities existed on that particular day for us to move forward. We need to work out how much the buyer paid. That's a given, and that's all right. And then in the 4th step, we work out what the buyer acquired, what the assets and liabilities are, and the standard refers to identifiable assets and liabilities. And that links back to something that Kevin had in one of his slides before. Because the 5th step basically says if we know what we acquired and what their fair values are, then we compare that to our consideration, and hey presto, if there's a surplus, so we paid a little bit more, then it's goodwill. And if we have a deficit, then it's you either did a really, really good deal, or there may have been a bit of an error, and the standard requires you to go and have a cup of coffee, my words, have a cup of coffee, look at it again. Because it's not very usual that you would see a bargain purchase, but it does happen, and sometimes it happens in distressed sales. So what's important to take away from this slide? Basically 2 things. The one is that we need to work out what those assets are that we acquired, and Kevin indicated before that some intangible assets are in essence separate from goodwill. And what we're trying to do in this step is identify which ones they are. Then we need to recognize them at fair value, which is a whole different issue. Kevin, if we have the next slide, please. So definitely not going through old ground that Kevin covered, but the 2 big picture requirements, if you like, for recognizing intangible assets in 38, and Kevin already indicated that business combinations doesn't say that we throw those rules out. On the contrary, we put a different lens really on it. I would put it in the definition category. And on the next slide, not to go now, but on the next slide, we'll talk about, not now, would be the recognition rules. So, and as you will see that actually, jumping ahead a little bit, but as you will see that it's probably more important to look at the existing slide and the criteria on the existing slide for the definition of what an intangible is. So, if we just take the brand example again, so I'm an acquirer, I'm acquiring a business. I think there's a really good brand in there, and I need to work out whether it's an identifiable asset that I need to put a fair value on. I don't think anyone would disagree that we tick the first box. It's an asset under the framework, so that's all right. We control the brand, that's given as well, and it's identifiable, and therefore we can distinguish it from goodwill. It's definitely separable from the business. I mean, very often we see brands that are used to generate even separate revenue streams. The little blue bit at the bottom is a bit of a spoiler alert, and I think I'm going to say it about another 754 times as we go through this process. If there's one thing you need to take away from the business combination angle on intangible assets, it is that irrespective of whether an intangible asset was recognized by the acquiree, the target, seller, call it what you will, irrespective of that, you likely will require to recognize additional intangible assets on top of the ones on the balance sheet. Next slide, please, Kevin. So I said that in the previous slide, there's a definition angle, and then there's a recognition rules angle. And whilst we don't really have to go through this because it hasn't changed, the good news, if you want to be recognizing intangibles, is that both of these criteria, which need to be met for you to recognize intangible assets in 39, both of them are assumed to have been met in a business combination. And it kind of makes sense if you think about it, because if we buy a business, we likely want to generate some future economic benefit. Sometimes it doesn't work out that way, but be that as it may. And to be honest, from a cost perspective, look, I speak to valuers often, and valuers can put a value on pretty much everything. And if the standard gets you to a point where you argue that it is separable, or it arises from a contractual or legal arrangement, then by definition, we should be able to assign an appropriate value from a fair value perspective on this. Okay, so what do we take away from these 2 slides so far? Okay, the acquirer acquires acquiree. We need to identify assets in that process, and we need to see if the definition applies, which was the previous slide. And on this slide, we give it a big tick and we say yes, we can acquire. Next slide, please, Kevin. So before we get into some of the, let's call them the practical issues, this is the second, third, fourth time that I've said additional intangible assets may be recognized irrespective of whether they live on the acquiree's balance sheet. So I'm going to use the brand example again. Assume that the acquiree's got a really good brand, but it doesn't live on the balance sheet. You would need to allocate value to the brand and then go through. The one thing I neglected to say in the first slide is the process by which we allocate value to assets and liabilities that we acquire is called the PPA, purchase price allocation process. The intangible assets need to be recognized at fair value on acquisition date. And I can tell you that that sounds pretty easy because, you know, fair value is value. And I just told you that valuers can value pretty much everything. It becomes very complex when you have different types of intangibles that all interact. So we'll use just a quick example on one of the slides that follow. We've already talked about the recognition criteria. One very, very interesting part of this, and Kevin indicated in his previous session that there's a point in time that you tick over to be able to recognize expenditures that you incur as development expenditures. And, you know, obviously you want to try and get to that point sooner. But if the acquiree, so the target actually has an in-process R&D project, and it may not have qualified for capitalization as yet, the acquirer would apply exactly the same rules that they would have as if it was a brand or anything else. And that likely could end up with the acquirer as part of the PPA or as part of the business combination accounting, recognizing a part of that R&D project. And the funny thing about that is the next day when additional expenditure gets incurred, we revert back to expensing. So it's almost like a bit of a blip on the radar for putting value on it. But that's where it goes. So Kevin, if you could go to the next slide and maybe the one after that. I want to talk to you a little bit about some of the issues that I've seen. You know, in my travels, I often deal with business combinations. It seems to be one of those things that if we do it right, if we get involved really early and we try and work out what the acquisition will look like on the acquirer side, because very often KPIs and indicators and even ratios are impacted by what it will actually look like on the balance sheet and the accounting. So if I were to say to you that the principle behind, and you're not going to find this in AASB3, but the principle behind business combination accounting when it was introduced was to say, hang on, there's a willing seller, willing buyer. There's a number that we negotiate. We get up to a price that likely would be indicative of future cash flows. If what we do is value the assets and the liabilities at fair value using cash flows, it's not such a stretch to say that potentially what we buy and what we pay for the business could be represented by assets and liabilities at fair value. That was the basic principle of AASB3. And then, of course, you'll say, but what about goodwill? And of course, some assets may not be able to be recognized, so we can't allocate value to them. So I'm going to use an example as workforce, so your people. Massive benefit, fantastic asset for the business, but it doesn't tick the box to be recognized as an asset, and therefore that kind of value that you may pay for is wrapped up in goodwill. But when I have that conversation around the deals table or with the board and the people that are looking to do the accounting, I get a bit of a weird look and maybe a bit of a, really? Because very often the deal price was not set based on necessarily looking at what was living in the balance sheet or even in the target. You know, you'd know this for those of you that are into doing deals, that very often the consideration determined with reference to a multiple of earnings, as an example. And whilst there would be reference as part of your due diligence, reference to the brand and how strong it is and how sticky our customers and those things, I don't think that that is necessarily always front of mind when the deal price is being struck. So it creates a bit of a disconnect. I was going to sort of give you a little bit more detail in terms of a mining example. So for those of you that are on the call and potentially have mining operations or have acquired mining operations, if what I said is true, and we buy a mine, the mine has a mine plan, it's got cash flows, it's got proved reserves, we potentially already have offtake agreements. So me as the acquirer, I'm looking at that business of the mine, I'm saying, hang on, I know what cash flow it's going to throw off. I'm expecting at least it to throw off. So if that were to be the case, what am I buying? Well, I'm buying the plant and the, if it's, be it the crushers or the processing plant, if it's in oil and gas, the facilities. What's left, can't say that that's goodwill, because I know it can't be goodwill, it can't be workforce or anything like that. So very often we end up with this thing called mining rights. And the funny thing about the mining rights, not half funny, is that some show that as part of the property, plant, and equipment, and some show that as part of an intangible asset. It demonstrates to you that that concept of what we pay for and what we allocate value to is very, very interesting sometimes to get right in practice. I can stand here on my high horse and say to you, look to see what kind of intangible assets you can identify as part of the business. I just also say to you that you need to use the balance sheet of the target as that starting point, because you need to see the liabilities and assets that you acquire. Hang on, if there are some intangible assets that do not live on the balance sheet, you're stuck. So it's harder. It's a practical problem, and to be honest, I see advisors during acquisition accounting engagements being appointed with the sole purpose of identifying separate intangible assets as part of a business combination and then valuing them. Now, I've got my own personal views as to whether you should be separating the process or not, but that's something to be worked out between the entity and its advisors. There's an interaction between the recognition and the valuation, but not from a pure technical accounting perspective. The technicians, the accounting technicians will say, and that's absolutely true, that your first step is to identify whether they are separate intangible assets, and separate to that, to then value them. However, if you run through that process and you end up with a massive amount of goodwill, it should trigger just a thought as to, well, have we actually identified everything we should be identifying through the process? The valuations could be very complex. So sometimes we're trying to value a customer relationship, customer list, we've got brands, we've got different parts of the business that contribute to the value that's being generated. And by trying to put value on them, we need to be very mindful that we don't duplicate value, and also don't leave any value that gets wrapped up into goodwill. Next slide, please, Kevin. I just, in the interest of time, I'm probably not going to take you through much of this, and I would have taken you only through a few of the highlighted items. These are the type of intangible assets that one could acquire in a business combination and therefore recognize, and you would see some of the trade names, etc., that I've listed, and particularly the customer related intangible assets will likely not have been recognized by the target themselves, and that of course leads you to the issue of having to consider what they are and what their values are. The favorable and unfavorable contracts is an interesting one. I was working on a deal. It went through in the end, but it was touch and go a little bit, because what effectively transpired was that the target had property leases effectively, and in very, very, very good locations. And the acquirer was trying to access the market by that, and they viewed the location of those properties and the leases to be very beneficial to the ongoing business after the acquisition. However, they tried to allocate value to the leases themselves, or to these contracts, and most of those leases were actually more or less on market. So you don't look at it from the perspective of saying, hang on, we think there's value in the location. You look at it from the perspective of whether the contract itself is favorable or unfavorable when you compare its terms to the market. In that particular one, it meant that most of the value that the acquirer was willing to pay could not be allocated to the contracts. And that would have meant that it had to be wrapped up in goodwill. And it almost fell over because the issue was, of course, well, hang on, if there's that amount of goodwill, is there a possibility of impairment later? Next slide, please, Kevin. We've got 5 minutes left, so I'll probably just wrap this up quickly. We've dealt with most of these things. I would say that we can tell you what the accounting requirements are, but please plan ahead. If you're doing an acquisition, it's something that you don't want to leave till the end. Valuation of the intangibles could be quite complex, and it has significant impacts. I had a call as recently as last week from a client that's looking to do an acquisition, and they said, we are pretty comfortable with the value of the assets and liabilities outside of intangibles. So we know there will be this blob between what we're willing to pay and what the value of these assets and liabilities are. That will be intangible assets, and part of that will be goodwill. We don't really care so much, but can you tell us what we need to do? And as it transpired, they did care, because the more value allocated to intangible assets, obviously legally under the accounting standard rules, the more value allocated to intangibles would have meant that there would be more amortization in their P&L. And for them, where they are and how the market views them, that's not a bad thing. It would have been worse for them to have more value in goodwill and then have a blob of goodwill impaired at some point in time. And the last one, which very often catches people by surprise, we've talked here about business combinations and how you look at intangible assets from a business combination lens. Just be mindful that in IAS 28, there's a requirement to do the equivalent of a notional purchase price allocation. So I've personally had deals where the value of the associate balance on the balance sheet had in it customer relationships and other intangible assets which no one actually thought of. That is hard. If you think it's hard to get information to value and identify these intangible assets out of a subsidiary that you control, imagine out of an associate, which you only have significant influence on.
Yeah.
And with that, I will hand back to you, Kevin.
Thanks, Etienne. Thanks for that. And that was well timed, like with 4 minutes to go. I'm interested in your last comment about the associate, because that I think is missed often in practice. And I'm glad you brought that up. But the other observation I wanted to make was just how much of our closing remarks, yours and mine, both focused on integrating this thought process for business combination accounting, but also R&D, actually into the larger strategy and the larger project plans, and really what's happening. There's, from a governance level, it's really important that these things drop out of what are you buying in a business combination? What are you developing in an R&D? Do you have the systems and processes and the advisors and the experts and the valuers in play to take you through this process so that the accounting can follow? Not the other way around, where you sometimes start with the accounting and then try and backfill it. And that was a theme I think came strongly in your section, Etienne, but I think also applies to the R&D section. It's a complementary process of accounting for what's actually happening in reality, not a backfill scenario where you start with the accounting at the year end and then try to sort of like suddenly make things happen from an accounting point of view. That's
I would definitely agree. I would definitely agree, Kevin. I think the interrelation between different parts and different disciplines. So in business combinations, certainly between accounting and valuations, but then in the R&D space between tax and accounting, it is important, and they do intersect quite significantly.
Absolutely. I'll finish off then. We've got a couple of minutes left, and I'll just take you through common issues and video resources. Look, the common issues, this one's not new. We've got links that are actually on the slides, which you can go to regarding interpretations that have come out recently on SaaS implementation costs. I'm not really going to go through this. We've done this in a number of webinars and also in our corporate reporting newsletter. You can just go search BDO SaaS implementation or click on the link. But it came as a galloping shock to a lot of people about the fact that they were capitalizing configuration and customization costs related to SaaS implementation. But it turned out that they didn't control the underlying asset, which was the software, which was the subject of the SaaS, which actually owned to the service provider, and therefore there was no intangible asset to begin with. That's an interpretation that has been out for some time now. But if that comes as a little bit of shock to you, there's some homework for you to go and look at on your own. I've also just put a link here to our corporate reporting topics page. This is an initiative that came out from BDO quite recently in Australia, where we've organized all of our resources that are available to the public by topic. And as you can see here, I've given you a screenshot of the intangibles topic. Here's an example of the IFRIC decision, so you can kind of go and hunt for what you're looking for. I've highlighted cryptocurrencies there, because something we do get on is what is the accounting for cryptocurrencies. There's an interplay there between intangibles and inventories, and the age-old question of whether it's a financial asset or not. So that's dealt with quite nicely on that page, just as a bit of a self-help. And then I've also just given you a link to our Corporate Reporting Insights subscriptions page. So this is our monthly newsletter. And if you don't get that delivered to your inbox, please go and sign up to it, also by following the link on the slide. So do you need assistance? I have put on the slides right now the names of the people who can deal with you on the R&D tax incentives from our tax team. I did not put their actually direct contact details, but if you click on the link and go to the R&D tax incentive page on our website, all of their photographs are there, plus their contact details. I would say these are your key starting points if you want to talk about R&D tax incentive, the actual incentive itself, whether that be from advice on how to approach it, right up to filling out forms and managing the process from claiming it. They can assist you with that. Also, you can come to Etienne and I directly, and we'll organize that ourselves. As always, I'll end the session with our corporate reporting and IFRS leaders around the country, and you can see Etienne's on there as well. So Etienne, thank you for assisting with that. I hope the wobble at the beginning wasn't too much of a distraction, and Etienne, I'm sure you handled it lovely. I guess the really key question, which we'll find out after this, is whether it recorded. So we might be doing this again for purposes of our recording. And once again, an ever-growing, expansive group of people who are joining IFRS and corporate reporting at BDO. So across the board, whether it's resourcing or industry specific, we'll be able to find the assistance you need to deal with those topics. Thanks, Etienne, and thank you everybody for attending.
Thank you, everyone.
Goodbye.
Bye-bye.